pencil and pen and get some notes. But if for some reason I go a little quickly, which I'll need to do because there's a lot of information going on, you will get a copy of the recording and you'll have access to it. So I want to emphasize that, okay? Now, at the end of the program, we will be taking some questions and answers. And that, to me, that's my favorite part. I get to learn a lot from you and what's going on, and you're going to learn a lot from what other people are doing. And the reason it's at the end is I find that a lot of the questions are answered somewhere in the program, and that's why we kind of leave it at the end, okay? Now, a little background about me. I've been told this picture is a little bit better looking than I am. But anyway, I'm a CPA. I'm a tax attorney. I'm a former IRS trainer of attorneys nationwide. So if you think of an IRS agent as a rat, I guess I'm the head rodent there, or I was the head rodent. I've been lecturing all over the country at my Tax Reduction Institute. Some of you may have been to my old day seminars. I'm a best-selling author of a book called Lower Your Taxes Big Time, which I highly recommend to all of you. And I have another book that's garnering some terrific reviews called Achieve Financial Freedom Big Time. And I've been a guest tax expert on Fox, CNN, CBS, and CNBC, and so on. And I'm not saying this to impress you. I just want you to know that I do know what I'm talking about, okay? But if you'll indulge me for about 3 minutes, I just want to give you a little sneak peek at a secret project that we've been working on here at TaxBot. And I'll do that as fast as I can. And then we'll dive into the real meat and potatoes, the education. And we'll wrap up with some Q&A at the end, as I mentioned. Anyway, what I said is I'm going to share with you something you're ready to learn how to use your vehicle to save a ton of dough. So I think you're all ready, right? There are two parts. And before I get into this, I want to give you a little overview. There are two parts to deducting your vehicle. There's the cost of purchasing your vehicle, and then the cost of operating the vehicle. It's very important to understand the difference because they're usually written off a little bit differently. And knowing the difference can save you a ton of money. So let's repeat. First, you get to deduct the cost of purchasing the vehicle. And this is called depreciation. And it usually happens over a period of time. Normally, cars are considered 5-year assets, and so it's normally over 5 years. Then you get to deduct the cost of operating and maintaining the vehicle. That's in addition to the depreciation. And this is the cost of things like your oil changes, gas, car washes, repairs, insurance, things like that. Now, we'll be able to talk about both of these things as far as your vehicle is concerned. Let me move forward now. Let me see if I can adjust the slide. There we go. With that understanding, okay, first of all, there's the standard mileage rate. There's two ways of writing off a car, the standard mileage and the actual method. By the way, if you're an S Corp or a C Corp, you can't use the standard. You have to use the actual, but don't fret because generally it's less profitable anyway, so you're better off with the actual. Now, method one, which we're going to discuss first, is the standard mileage rates. I do want to mention everything has been updated for 2020. So in case you're wondering about that, everything's been updated, all right? It's the most common because it's the easiest to do. But somehow being easier isn't necessarily better. And it ends up being less profitable than the second method, which is the actual method, okay, which most standard deductions are less profitable. And here's a brief rundown of how the standard method works. Every year, the government determines what the standard mileage rate is going to be. And they base it on the cost of the car and the actual cost of gasoline and the cost of repairs and so on. This year, the rate is 57.5 cents a mile for every mile you drive for business. So all you have to do is to track your mileage for your business and multiply it by that rate. Very simple. So for example, let's say you drove 10,000 miles for business. You would multiply that by 57.5 cents a mile, giving you a deduction of $5,750. Neat, clean, and sweet, right? But you don't get to directly write off the cost of buying your vehicle or the cost of operating your vehicle. This is in lieu of all this. This rate acts as kind of like a guesstimate of what it costs to drive your car. But the rate is usually based on driving a very inexpensive car. Usually this method is only good for inexpensive cars that cost less than $18,000 a year. Not a year, 18,000, period. And that assumes you don't have a lot of repairs either, by the way. But if you're, again, as I said, if you're an S Corp or a C Corp, you can't use this method, just to be sure. But don't fret, as I said, it's less profitable. Also, the government, there was some major changes on the automobile in the tax reform law that was passed at the end of 2017 that really made writing off the car much better, but they did not make dramatically similar changes to the IRS method. So now this standard method is even worse in comparison than it used to be. So I really, in most cases, don't recommend this. And if you are doing it, you're probably losing a lot of money. Method 2, which is normally the better method, is the actual expense method. Now, in this method, you're actually going to separate the cost of purchasing the car from the cost of operating it, and then deduct them differently. First, let's talk about the cost of operating the vehicle. That's probably the easiest thing to discuss. At the end of the year, you're basically going to add up all of your expenses associated with driving your car. Now, what are these? Things like gas, oil changes, car repairs, car washes, insurance, all those things. Then you'll determine what percentage of your driving was for business and what was for personal. So, for example, let's say you drove 15,000 business miles. Let me see if I can get to where I want to be here. Okay. Let's say you drove, I wish I had the right example here, but let's say you drove 15,000 miles in a year, but 10,000 of those were for business, okay? Therefore, 10/15 or 66% is considered your business usage. In other words, it's your business mileage divided by your total mileage. You then multiply, take that percentage and multiply by all your operating expenses. So for example, let's say your total operating expenses were $10,000. You multiply that by 66%. That gives you a deduction of $6,600 for your operating expenses. And by the way, who determines whether we use a car for business, like 66%? Does the IRS make that determination, or do we? And the answer is we do. And how do we do it? From our tax tracker, from our things like TaxBot, from our mileage log. And I'm going to get into that more often. I'm going to get into that later on. But that's only the operating side, okay? You also get to deduct the cost of purchasing the vehicle. Now, to help illustrate this, let me use an example. Let's say that you won the Powerball lottery, okay? And you had the option to take $250 million all at once, right now. You got $250 million with no penalty. Or you can take the same $250 million, but you get it over 30 years, okay? Now, which would you take? Of course, you would probably take it, you'd probably choose the lump sum up front because you can invest that money or simply put it in the bank and get interest. Getting it up front is much better than getting it over 30 years. And that's why most lottery winners take the lump sum up front, even though they're taking a lesser sum because they can invest the money. Well, the IRS doesn't give you that option. When you buy equipment for your business, you can only deduct the cost gradually over a few years. But generally, you'll be able to deduct the percentage of the equipment until you've only have got the full deduction. Now, the IRS calls this amount that you're able to write off each year of your purchase price depreciation. And they dictate, how long it'll take to fully claim your deduction. So, for example, the sooner you can depreciate a car is usually 5 years. And even that is extremely rare. It usually takes a little bit longer than that, like 6 years, okay? Now, with that in mind, let's do a simple example. Let's say first you bought a car for $20,000, all right? I know most cars are more than that, but I'm just picking $20,000. The government says that generally at a maximum, you can write off the $20,000 over 5 years, or about $4,000 a year. But it's even more restrictive than that because there are limits on how much business usage you can claim each year. And that business usage, by the way, is very important because that's what you can write off. That's your business mileage, again, over your total mileage, business to total mileage, okay? So the IRS takes the price of the vehicle, divides it into roughly 5 equal payments, which sets the maximum allowable deduction each year. So to determine your deduction for the year, you simply multiply your business usage times that maximum allowable deduction. But as I said, it's more restrictive than that because they have to take it over 5 years. So let's take an example. In year 1, you would write off roughly 1/5 of the cost of the car times your business usage, and that's your deduction. Year 2, 1/5. And this is a little more simplified version, though, of what it is, but it gives you an idea, times your business usage, and that's your deduction. You keep doing this each year, okay? And that's your maximum allowable deduction. But still, you haven't taken into account the full business usage. And by the way, as an example here, let's assume that you drove the car 90% for business. We'll use a good example here to show how this works. and your car was $20,000, so it's normally $4,000 a year. So 4,000 times 90% business use equals a $3,200 deduction. And this, by the way, one thing about depreciation is that it always reduces our basis. So our new basis now becomes 20,000 minus any depreciation that we took. So in this case, it will be 16,800. And by the way, you might wonder, why is that important? Because basis determines everything when you sell that car or for depreciation. Basis, if you sell it for more than your basis, you have a gain. You sell it for less than your basis, you have a loss. And the more depreciation you get, the lower your basis, because each year you take depreciation, you reduce your basis by that amount. Okay? Now, as you can see, in the second year, let's say I drive the car $4,000. Again, $4,000 is my normal maximum deduction, but I don't use it 50% for business. So my depreciation is 50% of $4,000 or only $2,000, which reduces my basis now down to $14,800. So as you can see, this might take you longer than 5 years because, we're assuming you use your car, that's assuming 100% for business. If it's something less than that, it may take longer than 5 years. It may take you 6, 7, 8, 9 years, just to give you an idea. So in our earlier example, we basically, you took your first year depreciation expense of $4,000. We added it to our $6,600 operating expense deduction, and that gives you a total deduction of roughly $10,000, $10,600 to be precise, okay? Which isn't bad. It isn't. But here's my important point. It gets even better, and this is something that you want to be paying attention to, okay? Because if you know exactly what kind of vehicle to buy, you can take most of the depreciation up front, kind of like the Powerball scenario we discussed. So instead of having to take it over 30 years or 10 years or 5 years, you can get it up front in the first year. That's right. If you buy the right kind of vehicle this year, you can write off 100% of the purchase price in a single year. I said it up to 100%. But again, it's based on the percentage of your driving was business related. So let's say you decide to buy a qualified vehicle this year, one of the qualified winners, like a Dodge Ram truck for $40,000. Now, let's say you drive that truck 80% for business. That means that in the first year, you could front load the depreciation and write off 80% of the $40,000 or $32,000. That's a big deduction, folks. And you can take then the remaining $8,000 in the following years to the extent used for business. Okay? But by knowing what you're doing, you're getting the right vehicle, you can write off most of it up front. That's the important point. And by the way, an important point is also this. I get this question a lot. Well, what about if I finance a car, Sandy? You get this deduction whether you pay cash or whether you finance the car. You still get the deduction. You do not have to pay cash up front. You get this deduction even if you bought it on December 31st. Even if you had only 1 day of driving. Let's say I bought it on December 31st, but I use it 100% for business. I can write off 100% of the cost of that truck if I'm very careful about this. Now, just a word of caution here. If you want to use this method, make sure you're going to keep the vehicle for at least 5 years and drive it for business. Otherwise, you're going to have to pay back some of these deductions if you decide to sell the car before the 5 years is up, or trade it in before the 5 years is up. And we're going to get into which is better, by the way. But if you know the rules and plan ahead, this is a great way to save big on your tax bill every single year. I mean, basically, if you made a lot of money this year, towards the end of the year, you say, oh, look how much money I made off to pay all these taxes. You can go buy a qualified vehicle and write off the business use, almost 100% of the vehicle up to its business use. Now, you're probably wondering, okay, Sandy, exactly what are the winners? What kind of vehicle qualify for this amazing deductions? Okay? And here's your answer. The short answer is certain kinds of trucks, vans, and SUVs. So let's cover trucks first. While the end result is the same, basically, you can write off 100% of the truck and the van and the SUV if you do it right. They're recorded a little differently as deductions on your tax return. So regarding trucks, according to IRS, the truck must meet the following requirements. Number one, it has to be a truck chassis. And that's true with the SUV too, by the way, and the van. Number two, it has to have a gross vehicle weight of greater than 6,000 pounds. That means carrying weight. And by the way, how would you know And that's true for your SUVs and vans too. How would you know whether your truck has a gross vehicle weight or SUV has a gross vehicle weight of over 6,000 pounds? You would actually open up the driver's door. I just found this out about 6 months ago. And there's in the door jamb, there's a metal plate showing net and gross vehicle weight. Look at gross vehicle weight, GVW, gross vehicle weight, and make sure it's over 6,000 pounds. That's the key. Okay. Although, besides looking at your door jamb, you can Google your model and find out what it would be with your monocle. Now, third requirement in order to write it all off, it's got to be new to you. Now, what's interesting, a lot of people don't realize this. They think, oh, I've got to have a new car. No, it's got to be new to you. So if you buy a used truck or SUV, that's okay, believe it or not. It doesn't have to be a brand new one. It just has to be new to you. It can't be one you bought last year, for example. But you can write it off the same way this year. So it must be new to you. Now, with trucks, this is the one thing that's different than an SUV. It cannot have rear seating. So if yours does, you come under the SUV rules. All right. Now, we talked about a qualified truck. Now let's talk about a qualified SUV or van, because they also allow you to write off 100% of the whole thing. To qualify as an SUV or van, you must meet pretty much the same criteria of a truck, except, so it's got to have a truck chassis, and it's got to have a gross vehicle weight of over 6,000 pounds, and it's got to be new to you. Okay, so it could be new or a used vehicle as long as it's new to you. The only difference is that an SUV or van has to carry passengers. It has to have rear seating. That's the difference between an SUV and a van. Now, I'm saying this, that you get the same write-off. You might say, well, why am I making a big deal? The write-off's the same, but you use a different section of the Internal Revenue Code. With trucks, you write off Section 179 of the Internal Revenue Code. With SUVs and vans, you get something called bonus depreciation, which allows you to write off up to 100% of the vehicle of the business use. The difference being that Section 179 is there forever. It's permanent part of the Internal Revenue Code. The bonus depreciation is only good through 2022. It starts dropping after 2022, a little bit each year until 2026, where it phases out altogether. So that's the difference. But other than that, as far as this year is concerned, there's no difference. You get to write off 100%. And the same thing is true with next year too, by the way. Okay? But the truck deduction does not phase out over time. It's written into the tax code in a permanent fashion. So you want to have, so who are the winners? Qualified trucks have a gross vehicle weight of over 6,000 pounds, qualified SUVs, and qualified vans. Oh, by the way, the BMW large SUV, get this, I was just noticing this, has a gross vehicle weight of 6,002 pounds. Now, do you think that's coincidental? I can just see those engineers saying, oh, we got to add some lead bars. All right. Now, what should you do after your vehicle has been depreciated completely? You bought it out, you bought the vehicle in, you bought the right vehicle, you wrote it all off, maybe in the first year. Now, at this point, what do? Well, you got a few options. You can keep your car and keep writing off the operating expenses, which is what I recommend. You could sell your car and buy a new one and depreciate it again. But as I said, if you sell it within the 5-year period, you may have to pay back some of that rapid depreciation that you took in the first year. The third option, which I do not recommend, is to donate it. Okay? And I'll tell you why in a few minutes. Or one of my favorite things to do, which I like, is something called the gift leaseback technique. Now, what's the gift leaseback technique? How would you like to write off your car twice? Not once, twice. Watch this. This is an amazing little trick that a lot of very wealthy people use to access tax-free money from their business legally to help pay for expenses in their family, like when they need cash injection for things like college, tuition, weddings. So essentially, it's a way of getting almost the equivalent of a deduction for college or tuition. Okay? And here's how it works. Now your car is depreciated. You get no more depreciation. That's it. It's done. Okay? You actually then give it away to a family member, maybe a child, a grandchild, a niece, nephew, and lease it back from them right afterwards. So you're still using it in your business. You're just renting it back from them. You have depreciated the car, so you got the deduction. Now you're deducting the lease payment. You're deducting the car twice. They get the income. Yes, they get the rental income, but that is exempt from Social Security and Medicare. They can use that rental income to pay for things like hobbies, school, or their future weddings. but you get a deduction for the whole thing. So you can fully deduct you get a deduction for Social Security. Your deduction is for Medicare. Your deduction is for income tax. But when whoever gets that money is only taxed on it from an income tax perspective, not for Social Security and not for Medicare. The lease payment is exempt when it comes to these things. And if we're dealing with minors, the chances are they're at a much lower tax bracket than you. So that's the point. And there is and by the way, I should note there is a limit how much money they can receive as income that isn't earned. And they're actually doing, so I do want to emphasize there is a limit. In 2020, the minors can earn up to $2,200 per year income tax free, just so you know. After that, they'll have to pay a lot more. It's I think they're at their the trust tax rates, which are very high. So you generally want to limit it to about $2,200. They're still in about a 15% bracket on the next roughly $6,000, but so I guess you can do up to about $8,000, $9,000, but generally you want to limit this to about $2,200. If your kids are over 18, then this doesn't apply. Or actually, if they're married, let me rephrase this. If they are married or they're not full-time students and they're over 18, this doesn't apply. If they're married, if they're not married and they are full-time students, then this age 18 applies to age 24. Once they hit 24, this doesn't apply. So be aware of that. Okay. There's no limit once they hit age 24 and they're full-time students. If they're not full-time students, then it stops at age 18 at that point. And you have no problem. Now, the rates for the lease, I want to emphasize something here, are defined by the IRS. So how much can you lease a car back from? If you Google the IRS lease tables, you actually go to irs.com and Google lease tables, you'll be able to find your car. It'll tell you what the value of your car is. You got to know what the value is, and it'll tell you how much you can lease it back from. Generally, as a rule of thumb, you can generally lease it back from somewhere between 1/3 to 1/4, or between 1/3 and 40% of the fair market value of the car, between 1/3 and 40%, somewhere in that range. And that's about the annual lease payment each year for 3 to 4 years. So if you could sell the car, let's say you have a fair market value of $20,000, then you can gift it and lease it back for roughly $5,600 a year. You'd have to go to the tables, but that's pretty amazing, right? Now, this is another way of, by the way, another fantastic way to unlock free money is to use what I call the two-car method. And this is as easy as it sounds, by the way. You know, do you drive one car for business? You probably do. Do you own more than one car? You probably do. If you own a second vehicle, such as a family minivan or a commuter car, or whatever, then you might want to consider putting business mileage on both vehicles. Now, why is that? Because you're essentially sitting on a treasure chest of free money. And this is, I think, easier to understand with an example. You know, all vehicles are determined by how many business miles you drive during the year. So in this scenario, let's say you drive one car and your business miles add up to 22,000 miles for that year. And you put on another 2,000 of personal. Now, as we learned, that means that 92% of the expenses for your vehicle will be deductible. 92% of the gas or the oil, the insurance, the repairs, the tax, the license, and so on. And you get to depreciate the vehicle in addition. Now let's look at an alternative scenario where you still drive the same 22,000 miles for business. So that's not changing. But, okay, in this scenario, you put on 18,000 miles on that one car and another 4,000 on the second car. Same 22,000 miles. So in this example, your business use percentage dropped from 92% to 90. You figure, oh, well, it dropped down. However, by putting a couple thousand miles on your second car, you're getting an additional 51%. Now, maybe I'm crazy, but add up these two numbers. You're getting 90 and 51. You're getting 141%. When you total all the operating expenses and multiply by your business usage, now you can, and by the way, you also get to claim some depreciation on the second car, which you weren't able to get. The impact is huge. In this example, you created almost $4,000 in extra, in fact, more than that, almost $5,000 in extra tax deductions with the same number of miles driven. I want to emphasize that. Isn't that something? You know, it really does pay to know the rules. If you have two cars and both are not being written off, you should definitely consider doing this. Now, if you don't have two cars in your family, I'm not suggesting you go buy another car. Or if you and your spouse are both in the real estate business, and you're both already writing off both cars, I'm not suggesting you switch off. This should only be used as if you have one car that's already in your business, already in your family, I should say, that's not being written off. Okay? But if you do, you can basically have this asset and squeeze out an extra couple $1,000s out of it a year, right? That's certainly worth it. Am I right? I mean, that's what it's worth. Now, let's turn more of your personal driving into business driving. That's the next way to increase your deductions. Let's face it, the more business you have, the better the write-off, all right? Remember, your deductions all hinge on how many miles you drive for business. So if you increase your percentage, then you have dramatic savings. So how do you turn more personal driving to business? Let me give you an example. Let's say you want to drop by your mom's house, or maybe you're going to take your kids to dance practice, or you do a SAT tutoring or football practice. You know, normally personal errands are not deductible. Seeing your mom is normally not deductible. But what if you could find a legitimate business reason that's near your mother's home, or near the dance practice, or near the SAT tutor? If you can, then you can turn a business portion of that trip and make that a business trip, and the return trip would also be deductible drive. So if, let's say you're a realtor, perhaps you set up a meeting with a neighbor to run a valuation on their home, or look at a FSBO nearby where your mom lives, or maybe you can drop by flyers in the neighborhood. No matter what your business is, I want you to think of it as a prospect or a client you could visit. Think about whether you can make that into a business trip. And then you could document that visit in a mileage log, and you could be substantially increasing the percentage of business driving you're taking, and thereby saving thousands and thousands of dollars. I can tell you, as professionals, we do that all the time. If we're doing any personal stuff, like if we're taking our kids tutoring, something like, we always ask ourselves, gee, do we have any kind of stop we can make along the way or nearby that are business related? If we can do that, then the trip to see your mom or a personal would be deductible if it's nearby. Now, by the way, since we're talking about business mileage, and since you now know what you need to keep a business, you need to keep a mileage log, I want to talk to you for a minute about these two facts, because they are important. Without question, automobiles are the number, and vehicle mileage is the number one audited category by the IRS. I want to emphasize that. And the reason is it's a big ticket item, it's the most used, and it's the most abused. The second big thing is you look at the tax court cases, the IRS wins over 88% of the audits and of the court cases that they conduct. If you put these two things together, it's pretty easy to see that it's kind of a slam dunk case for an auditor to look at someone's mileage log. Even if you have one of the run of the mill, so to speak, mileage tracking apps. Now, why is that? Here is kind of the dirty, stinking truth about mileage tracking applications I've seen out there. Almost all of the mileage logging applications on the market are not following the IRS rules for documenting a trip. I want to say that again. Make sure you heard me. Almost all of the mileage tracking applications on the market are not following the IRS rules for documenting the trip, as strange as that sounds. This means that their users are not really protected. They think they are, but they're not. And I'm serious. It sounds like a bold claim, and it is. But let's look at what the IRS actually requires to have a legitimate mileage log. And if you're using something other than TaxBot, you ask yourself, do they really have this? The IRS specifically outlines in Section 274D of the Internal Revenue Code, just so you know where I'm getting this, that you need to keep a record of your business mileage that includes 4 important elements of proof. If you are audited and you don't have every single one of these elements, this could cost you big time. So here are the 4 mileage documentation requirements from the IRS. This is what you need, folks. Number 1, and I took this right out of the IRS publication. You need for each trip, you must record the total mileage driven for each trip. If you want, you could do the beginning and ending odometer reading, but the total mileage driven. Number 2, the date of each trip. Number 3, the business destination of each trip. In other words, the address or any person you might have seen. And 4, your business purpose for the trip. And I want to emphasize that again, your business purpose for the trip, because that's where a lot of mileage logs leave out, or they don't mandatorily require those. Most of the most popular mileage trackers on the market that I've seen satisfies one or two, and maybe even three of these points. But almost all of them are neglecting number 4, getting a specific business purpose. In most cases, these apps present the user with a record of each trip after it's been automatically tracked. The user is instructed to swipe one direction to designate it as a business trip and the other direction to designate it as a personal trip. And that's it. You see the problem? If you're classifying a trip as business, but you're not giving a business purpose for the trip, then there is no business purpose recorded. Simply swiping is not enough. Does everybody understand that? This is very, very scary, because in case after case, IRS has repeatedly disallowed all of someone's mileage deductions when their mileage log didn't contain, and I want to emphasize this, a specific business purpose written down. Okay? Hope everybody heard that. And I want to cite a very famous case of Royster versus Commissioner. The business owner was told to keep a log, and they religiously wrote down all his odometer readings every single day for each one of his business trips. The problem is he did not write down the destination nor a business purpose for each trip. In fact, here are a few excerpts from the court's ruling. I actually quoted some things from the ruling. Quote unquote, the logs do not contain any entries regarding the business purpose for the trips or the destination of each trip as required by Section 274D of the Internal Revenue Code. Accordingly, we conclude that the logs do not adequately substantiate petitioner's car and truck expenses. The IRS disallowed all, I want you to get this, this is for 3 years, all 188,991 business miles he had accumulated over the past 3 years. And if that isn't enough, he had to pay back taxes and penalties. It cost him dearly. If this would have happened to you today and you had used the IRS standard mileage rates of 57.5 cents a mile, it would have, you'd lose it, you have a deduction of somewhere around 110,000. You actually would lose about $110,000 in deductions. And that's before penalties would be applied. It's very, very important to keep good records. I can't emphasize that enough. And I'm talking about specific things. I'm not talking about generalities. If you have a mileage tracker that says sales call, because it's already built in, you just check off which box it is. That isn't enough. IRS wants you to tailor for each trip. It's very, very important. You know, I don't know if you're like me, you like watching criminal law shows like NCIS and that type of stuff. You know, in criminal law, you're innocent until you're proven guilty. In tax law, you're guilty until you prove your innocence. You know, when it comes to certain business deductions like travel and meals and vehicles, the IRS really doesn't mess around. I want you to think of an audit kind of like a police investigation, only you're not innocent until proven guilty. In tax law, everything's flipped. You're guilty until proven innocence. To prove your innocence, all you need to do, and that's the interesting point, is to provide a mileage log that has all the items we discussed earlier, including the business purpose, okay? That's all you need, folks, and you'll never have to worry about an IRS audit again for that. It's that good. Basically, a business purpose can be better understood by answering the question, how will this business benefit? How will this trip benefit my business now, or how will it benefit me in the future? Think of it like an alibi. You know, when an NCIS agent or some detective interviews a prospect, they want an alibi. They want to know where they were. And if they give a good alibi, well, they move on to the next person, okay? But what the key is with alibis, the more specific the business purpose, the more specific the alibi, the more likely the police or the IRS is to accept it. So, for example, which is more specific, okay? Let me give you a couple of options here. Let me back to where I was. Method A, client meeting. That was my alibi. Or number B, Sales presentation to Acme Company for our anvil dropping crane, or sales presentation to Sandy Botkin for the listing on 121 Main Street. You tell me, which do you think is better? Clearly, B is more specific. It shows that you had a more specific business purpose for the meeting. This is how IRS looks at a mileage log. If you understand how they think, you won't have to worry about them anymore. They want specifics. The problem is most apps on the market today, I'm sad to say, are not gathering this type of specific information, leaving you unprotected and vulnerable to losing your deductions. No questions, okay? So you really have two options if you want to protect yourself. You have option one, change how you use your current application, find places to take notes and create an alibi for every trip. You can do that. You write down the purpose of each trip and you should be okay. But be careful, because you usually have to be proactive in this approach, and it's very easy to slip back into your old habits of just classifying something as business without a purpose written down. Option two is to switch to that was built for compliance, like TaxBot, if I may put in a 50-cent commercial here, okay? And that will keep you compliant. I do want to emphasize that TaxBot automatically tracks your mileage, so you don't have to remember to do it. When you start driving, even TaxBot automatically starts tracking in the background. It turns itself on. You don't even have to remember to do that. That's actually one of the biggest complaints people have, is they forget to turn on their whatever tracker they have. TaxBot automatically turns itself on when you start driving. And then when you have some time, you can go back and classify your trips. And when you stop for 5 minutes or more, TaxBot turns itself off to save energy. I mean, it really is a very simple app in that regard. Okay. We've done some fun stuff to make it easier than most other apps to help you identify and categorize trips. For example, let me give you an example of what they do in TaxBot as an example. We show you a full map with a detailed route of your trip so you can identify landmarks to help you remember what was happening. And we are one of the only ones to include a full map of the actual trip. Other apps mostly show you two maps with a pin on each address, like as the crow flies, so to speak. So you have no context for the route, and it's kind of hard to remember too. Many of them don't even show you the full address either, but TaxBot does. And to make it easier, TaxBot integrates with your calendar. So if you have a trip that matches your calendar event, listen to this, it will automatically pull those details into your trip as a legitimate business purpose for you. It'll actually take it from the calendar. Now, at the end of the day, now do that at the end of the day. TaxBot makes sure that you have the purpose entered before it classifies the trip. It absolutely mandates that happen, so you can rest easy. So not every tracker does that. TaxBot does. Now, I want to tell you a little secret project that I'm working on that I think is going to make this a lot easier too. What I'm going to show you is not currently available in the market, but I think you're going to like it. We recently did a short survey nationwide about how real estate professionals like you are currently tracking your mileage. And one of the questions they asked was, what's your biggest frustration with whatever mileage tracking application you're using? Okay, that was the question. Well, the survey, the results weren't even close. There was definitely an overwhelming frustration concerning the mileage tracking applications that are currently on the market. And you probably already know what I'm about to say. Of course, the number one frustration, by a landslide, by the way, is the amount of time it takes to go back and classify your business trips. It's nice to go swiping left and right as business, but then you got to go back and classify it when you get home, all right? This was the response from a gal named Maria Roken, which is very typical. She said, quote unquote, I want to give you her quote, it's very interesting. I hate having to go back and classify my trips. I end up putting it off until I have over 400 plus trips to go through. I can't even remember what they were for. It takes forever. I wasted an entire weekend last month just going back classifying all the trips that I took, and I wish there was a better way. Does that sound familiar to any of you? Okay? That is why I'm very excited today to show you a real cool new device that we created that makes the classification of business trips dead simple. It's a Bluetooth device called TaxBot Voice, and it allows you to track and categorize your business mileage. And here's the important point, while you're driving, using just your voice. So let that sink in. You're going to classify your trips while you're driving, so you'll never have to sit down and try to remember what your past trips were for. You don't have to go back in the home on the weekend and start reclassifying everything. Here's how it works. TaxBot Voice is a small Bluetooth device that installs easily on your vehicle's visor, similar to a garage door opener, okay, or on your dashboard. So the first thing you'll do is to pair it with your phone. That's the first thing you do. Now, when you start driving, TaxBot Voice will notify you that a trip is in progress. It simply say, TaxBot is available, and it opened up, and it's ready to be classified. You can classify your trip by simply pressing either personal or the business button on the device. That's all you have to do. When you press the business button, here's what happens. It's very simple. In fact, this is what it looks like. You'll see it on the left over here. A microphone will become active for 10 seconds where you can simply speak the business reason for the trip, which, by the way, is required for IRS compliance. Let me emphasize that again. So all you're doing is talking while you're driving. The recorded purpose of the trip is then sent via your phone to TaxBot's mobile app over the Bluetooth connection, and the recording is transcribed and saved for you in a matter of seconds. All your record keeping is now done while you are driving. And if that isn't cool, folks, I don't know what is. I mean, I hated having to go home and reclassify everything. That really changes the whole landscape. Okay? So you can dictate, met with Johnny Appleseed about investing in a new orchard, or met with Sandy Botkin about the listing on 9914 Bald Cypress Drive. Okay? No, look, as great as Siri is, a lot of you may be asking about Siri, there's only reactionary software. You have to remember to ask Siri to classify your trip every time you got into your car. We've actually tested this approach extensively, okay? So Siri itself doesn't do it. And what we found is pretty conclusive. When you use Siri, the trip never gets properly recorded. As much as I like Siri, it doesn't. We found that the last thing folks are thinking about when they hop into their car is classifying their mileage that they're about to rack up. It's just simply human nature. And changing human nature is hard, just is. That's why we created a device that automates this for you. So you have one less thing to have to worry about during your daily business day, which is already busy. You know, TaxBot Voice, that's what it's called, will automatically ask you to classify your trip as soon as you start your car. Then it will sync up with the TaxBot application that's tracking your trip in the background. So you'll never forget and won't have to go back to record the vital information. Problem solved, okay? Now, I do want to emphasize that this device is not available yet. You can't get it. Sorry, it is what it is. But it is being manufactured and should be available by the end of the year. But I am absolutely super excited about it. And I think that it will make mileage tracking your mileage just a ton easier. And I've been waiting for over a year to tell people about it. So thanks for indulging me. I get a little excited about this stuff, as you can see. If you're interested in getting one of these TaxBot voice devices, I'll give you a special link at the end of the webinar where you can get a pre-order discount. But that's it, okay? First, however, for those of you who are interested, TaxBot also tracks your receipts and expenses. And I like to say it's about as simple as it gets as a selfie. I mean, it's not as easy as with TaxBot Voice, but it's still pretty darn simple. You can simply snap a picture, if you don't know much about TaxBot, of your receipts, and then TaxBot actually reads the receipt and matches it up with your bank account or credit card. It will then fill in the missing data and will then categorize the transaction. All that's left for you to do is to approve the entry and you're done. Does all this automatically. I mean, I don't know of anything that does this. And at the end of the year, you'll simply print out your bulletproof report with your complete mileage log, your profit and loss statement, photos of your receipt, and then backup data is also included. And then you want to just hand it over to your accountant and you're done. Well, okay, we just covered a lot of information, and thanks for sticking with me, just to give you an idea of what it's about. But by way of saying thank you, I want to reward you with an exclusive discount on our TaxBot app, and you will get this. Now, normally, just so you know, TaxBot is normally $120 a year, but today you can get it for just $100 for the entire year, okay? Just so you know. And by the way, I've got an even better deal. For an extra $29.99, you can get your first year of TaxBot Voice, plus all for TaxBot Voice, plus the order that's included with TaxBot as part of that. So be aware of that as well. And that's coming in late 2020, beginning of 2021, almost like the vaccine for the COVID. Okay. And by the way, just so you know, on top of that, I'm going to throw in a free 15-minute tax strategy call with one of our TaxBot certified professionals to see if they can help you. And that's normally a $50 fee, so be aware of that, okay? And by the way, finally, we're even going to throw in a $100 credit that you can use towards any of our paid training programs if you want to attend any of our educational seminars. So it's essentially you'll be getting it for free. So essentially you get TaxBot, you get the voice, you get, which is worth $129. You get an optional 15-minute strategy call with our TaxBot certified professionals, normally $50. You get a $100 education credit for our TaxBot minimization tax training program, which are similar to today's webinar, but goes into a lot deeper. And that's a $400 value for only $129.99. And of course, we offer a free 90-day money-back guarantee. And if you're not happy, simply call and get your money back. It's a completely free 90-day guarantee. If that sounds interesting, please don't wait. I usually take down these offers within a couple of days because it compromises our pricing in the marketplace. So be aware of that. So be sure to get this deal. You want to make sure you sign up for the offer within 24 hours. Okay. What I'm going to do is you can get advantage of it by going to taxbot.com/TAOR. That's taxbot.com/TAOR. Okay. All right. I'm going to have Tori ask me some questions. If you have any questions, please give them to me, and I'll be glad to take them right now. Tori? Hello?
Hello?
Oh, here we go.
Hi, sorry, my internet cut out. What was that?
I'm sorry?
My internet cut out. What was that? What were you asking?
Oh, you have any? Does anybody have any questions? We're ready for questions and answers.
All right, let's see.
Yeah, they're having a lightning storm. That may be what did it. I know there's a lot of lightning storms around here.
Yeah, we've been having a lot of wind in Utah, so it's been interesting with internet and power for the past couple of days.
Yeah.
Someone asked if the business is in their name and the car is in her husband's name and they file taxes together, can she still deduct the car?
Good question. As long as you file a joint return, you can absolutely you can still deduct the car, even though the car is in your spouse's name. That's an excellent question.
Another question is, if someone shows 5 homes in a day, where do they start their mileage tracking? From the office or from home to home?
Say that again?
If someone is showing 5 homes in a day, do they start their mileage tracking from the office to the home or from each home to home?
All right. The way business mileage starts is it depends on whether your home is your principal place of business. TaxBot automatically turns it on when you start driving. So then you classify between business and personal. If your home is your principal place of business, and we'll get into that with a home office type of area. We do home office seminars, which we just did actually, I think last month or 2 months ago, or maybe we'll do another one for Texas. Then all your mileage from your home for any other business stop, even though your broker's office, would be business mileage. If your home is not your principal place of business, then the way that works is your first stop is considered personal, and then everything after that is considered business. And then when you go back home again, it depends on whether you go from a business stop or from a personal stop. You go from a business stop, then it's also business as well. If you go from a personal stop, then it's not deductible.
All right. And then someone asked if they bought a new car last year and sold it, and they're buying another one, can they use the deduction 2 years in a row on 2 separate cars?
All right, it's an interesting question. All right, if you bought another car, a lot of it depends on what kind of a deduction you took on that car last year. If you took just regular depreciation, it's not much of a problem. If you took the full write-off, where you wrote it off in 1 year, and then you sold it the next year, remember what I said, cars are generally 5-year assets. In order to keep that deduction, you got to keep it for 5 years. If you only kept it 1 year, you will have to give back 80% of the depreciation you took in that first year. Now, when you buy the new car, then you can claim a full deduction for the new car to offset that and maybe even exceed that. But essentially, you got to recapture or pick up most of the depreciation in case you didn't keep it the full 5 years. And then you claim the new depreciation for the new car that you buy. And that's the way that works.
Awesome. And then another question, how do vehicle write-offs work if the employer pays a vehicle allowance monthly?
Excellent question. You have a couple choices when an employer gives you an allowance. One is to take the allowance into income and then report all the deductions and then offset that whole thing. If the deductions exceed the income, you get a deduction. The second option, which I like better, is take all the deductions you'd normally have for your car, and you have a little reconciliation that you attach to your tax return. You're allowed to submit anything you want with your tax return, and you put a little reconciliation. Essentially, you take all the deductions, subtract out the reimbursement that the employer gives you, and what's left over is deductible. Now, let's make one exception here. Employee business expenses are not deductible. So if you're driving as an employee, you cannot write off the expenses. Whereas if you drive as a self-employed individual, let's say you got a real estate business part-time, then it would be deductible. But if you're solely an employee, it would not be deductible. So be aware of that. They changed the rules in 2017, actually starting 2018, so that employee business expenses are not deductible. But if you're self-employed, part-time or full-time, no problem. All of this applies to you.
Okay. And if you have a vehicle prior to becoming an agent, how do you handle the depreciation?
That's a really, really good question. I'm glad you asked that. That's really good. Sometimes we don't have enough time to get through everything here. A lot of times a brand new agent comes on to real estate, they already own a car. And what can they start writing off? And they don't know. It's very hard to find out what the answer is on that because the IRS publications don't say much about it. Here's your answer. The amount you write off, and this is all in our TaxBot videos and things like that we have in our more in-depth education training. But the amount you're able to write off if you had a car for several years is the lower of the original cost of that vehicle or today's fair market value when you start your business, whichever is lower. So let's take an example. Let's say you bought a Toyota for $25,000 5 years ago. And today it's worth $8,000. Should be that lucky. And now you start becoming a realtor. The amount you write off is the lower of the original $25,000 or at the $8,000, which in this case it's $8,000. That's what you start depreciating, which is the fair market value. And then you write that off over 5 years.
Okay. And someone says, if I have my name and phone number on my car for advertising, I'm advertising all the time. Can I write off all my mileage?
That's a really good question. This is why I like these questions. These questions get into a lot of things that I normally don't necessarily think about. The answer is not necessarily. The only way you can write off all your mileage from your home is if you make your home your principal place of business. Simply having the home address on the card is not enough. Your home has to be your principal place of business, which is basically where you do all your administrative work. I would recommend that you either get my book, Lower Your Taxes Big Time, and read up the home office chapter, or even better, get access to our videos and listen to the home office segment, because that gets into the principal place of business. The card itself is not enough. And by the way, the same thing is true with a sign. If you put a big sign in your car, a lot of times people ask me, what happens if I put a big sign on my car? That won't make a difference. Or you can write off as the sign. The key is your business mileage versus your total mileage, and simply putting a sign on your car doesn't change whether something is business versus personal.
All right. And then when showing houses, do you have to have every stop in between? Do you have to have every showing address, or just the total for the whole trip?
That's a great question. Yes, you should have each address for each showing. Now that's the long and short of it. The good news is that TaxBot originally was designed for realtors. We designed it for realtors. That was the first market. Now we extended it to other people like financial planners and National Association of Accountants and all kinds of other people. But realtors was our first when we designed it, that's who we had in mind. So when you go to a showing, one of the things that you can do is merge the trips so that you only have to put one business purpose, and yet that'll work for all the showings of all the properties. Now, you will have to have each address, yes, but you can use, it'll automatically show the business purpose as the same for each of those properties as the showing, okay?
All right, and then what if I already did my 2020 taxes with the standard deduction, the 57.5 cents a mile? Can I amend it with this method?
Oh, that's a really good question. Yes, I believe you can amend the return, I believe. I'm not 100% sure, but I believe that's the case. Go speak to your accountant about that and see whether you can do that. But I think you can file an amended return. But again, the key is you're going to have proof, which means a good mileage log of your business mileage, which you, by the way, you need under both methods. A lot of times people don't realize this. They figure, well, if I use the IRS method, I won't need the same documentation. Not true. You got to have a mileage log regardless of the method that you use. And people think, oh, because the IRS method is easier, and maybe I don't need a log. Not true. You got to have a mileage log. The only difference is with the actual expenses, you have to have them documented as to what the gas is, what the oil is, what the repairs, and so on. Whereas with the IRS method, you don't need to do that. It's just 57.5 cents times your business mileage. But that's the only difference. Other than that, you still need a mileage log.
Okay, and I am seeing some questions asking if they're going to get a recording. Yes, you guys will all get a recording after this sent to your email, so you can go back and rewatch it as well. And then another question for you, Sandy, is TaxBot a write-off?
Absolutely. TaxBot is 100% deductible, by the way, folks. That's something that's very important. Oh, one other question I just noticed. TaxBot is because a lot of people have spouses who are also in the real estate business. TaxBot works on multiple accounts. Let me rephrase this: multiple businesses, multiple cars, simultaneously on one account. So, for example, a lot of times people say, "Well, do I need an account for me and one for my spouse?" No, just on one account. You can use it for your business. Your spouse can use it on their business. You can each be driving separate cars. It'll keep track of your mileage for each of your cars. At the end of the year, it'll give you a separate profit and loss statement. It'll work on both businesses with one account. It also works on different devices. I use an iPhone. I probably will never switch from my iPhone. My wife uses a Droid. I use TaxBot on my iPhone. She uses TaxBot on her Droid. It works on the same account, doesn't matter.
Okay, let me see.
These are great questions.
Another question is if you have to renew the voice subscription every year, and that is no, it's just the cost of renewing your TaxBot app subscription. So you pay the one-time price for the TaxBot voice, and then you do have to have the TaxBot app to make it work, so you do have to pay the price to renew that.
That's correct. TaxBot is renewable at the $100 a year. In fact, it's a little less when you're a current subscriber. But TaxBot voice, you pay one time and you get it forever for the rest of your life.
Okay, and we'll do one more question because it looks like we're at the hour. Someone says, if you have a home in one state and travel to another for work, can you deduct the mileage to and from one state to the other from work?
If you have what in one state? I didn't hear the beginning of the question.
So if you live in one state and you travel to another for work, can you deduct the mileage to and from the one state and the other to work?
Generally, and there's a lot more to that. Generally, the answer is no, because that's like commuting. It's like going to the same office, just happens to be into a different state. But that's the answer. That's like considered commuting. Now, despite what I just said, you may be able to convert that into business. A couple ways of doing that. One way is to make your home your principal place of business, in which case then all your trips from there on in becomes business mileage. The second way to avoid that problem is to go to a temporary business stop on the way to the other office. So, for example, to go to a FSBO or a listing or something you don't do normally, the same listing, or a seminar, something unusual, and then go from there into the other office. That mileage for that day would be business mileage. But if you simply go every day from your home to an out-of-state office and back, that's considered commuting. It's not deductible. Now, once you leave that office and go to business stops, that's all business mileage. but going from that home to that office without making any business stops along the way is considered personal.
Okay, I think that does it for questions, unless you want to take time to do, oh, nope, I think that's it. So we're at the
Yeah.
hour.
All right, let's do it. Folks, thank you for coming on. Take advantage of my bottom line is, folks, do something. You know, obviously, if you want to have a fireproof safe and keep another app somewhere, fine, but do something. You can be sure that when it comes to your vehicles, IRS is really going to be auditing these things. It's an easy thing for them to do. So having a good mileage log like TaxBot is so important. If you want something easy, quick, and simple, it doesn't get much better than TaxBot. But the point is just do something. That's really the bottom line. And I would strongly urge you to consider TaxBot Voice. I mean, to dictate it and automatically have your business and personal mileage put in there and not have to go home and swipe things and work on it all the time is just, a game changer in my opinion. And it will make your life, I think, a lot less taxing. Okay. Thank you all for coming, and I really enjoyed it, and take care.